Welcome to Market Radar's special segment on the 2024 economic outlook. Today, we will be diving into the key factors that traders, economists, and global markets are looking out for in 2024. Building on the unexpected resilience of 2023, market experts are forecasting relative stability in 2024. A key factor is the improved balance in the labour market, with the gap between job openings and unemployed workers significantly narrowing in 2023. US wage growth, now around 4%, reflects a more balanced economy. This moderation plays a critical role in the Federal Reserve's approach to inflation. Across the globe, inflation is decelerating, though more slowly. In developed economies, it has eased to around 4% from a peak of roughly 8%. Analysts are observing that inflation has been consistently falling below forecasts since April 2023. By the end of 2024, it is expected that inflation rates in the US and Europe will edge closer to the central bank's 2% target. In 2023, gold and silver have both held up quite well, with gold gaining 12.6% year to date and silver more or less flat. The Federal Reserve's interest rate pause due to successfully lowering inflation and the widely touted pivot in 2024 to reduce interest rates is expected to move into a much stronger bull market for precious metals. For the stock market, 2024 looks to be a year of strategic navigation. Election years historically favour stock growth, but recent market surges suggest some gains have been preempted. This could influence the growth trajectory in 2024. Experts predict continued volatility driven by geopolitical shifts and economic changes. A resilient consumer data and a supportive Fed could fuel market jumps. Yet, challenges like global growth slowdown and heightened geopolitical tensions might counterbalance these gains. Traders should watch for signs of market resilience, focusing on sectors that are poised for growth despite the challenges. This includes emerging tech themes like AI, semiconductors, and cloud services. The key will be identifying opportunities in a landscape marked by both risks and potential. The newfound competitiveness of bonds against stocks may turn investment decisions in 2024. JP Morgan's latest analysis reveals a compelling trend. For the next decade or so, US aggregate bonds are expected to yield returns over 5%, standing out for their substantially lower volatility, just a fraction of that seen in large-cap stocks. On the other hand, large-cap stocks are forecasted to offer about 7% returns in the same timeframe. This highlights a critical decision for investors, choosing between the lower risk profile of bonds and the potentially higher gains from stocks. Importantly, despite their lower volatility, bonds don't necessarily lack in returns. This balance suggests that for long-term investors, bonds could offer more appealing risk-adjusted returns compared to stocks, shaping a strategic approach in portfolio management. Economic growth is projected to be stronger in the US than in the Eurozone. The OECD predicts the US economy will grow by 1.5% and 1.7% in 2024 and 2025 respectively. Meanwhile, major Eurozone economies are expected to grow less than 1% in 2024. Early signs of global trade improvement and the end of interest rate hikes are lifting consumer and producer sentiment. Increased spending due to a decrease in saving rates along with anticipated central bank policy shifts are expected to ease financial conditions. Markets expect the European Central Bank to announce the first rate cut in June 2024, with a gradual reduction to 2.75% by year-end and potentially reaching 1.5% in 2025. In 2024, it is widely expected to see some dynamic movements in the Euro-US dollar pair. When it comes to the fundamental outlook for the Euro-US dollar pair in 2024, the most important theme will be central bank interest rate cuts. Traders are pricing in roughly 5 or 6 interest rate cuts from both the Fed and the ECB, with the easing cycles projected to begin as soon as March. Technically, the 2023 range between 1.0500 and 1.1250 will be a crucial reference. The Bank of Japan is the only central bank expected to move in the opposite direction in 2024 by exiting its long-standing negative rate policy. With Japan's record-setting debt-to-GDP ratio exceeding 260%, the Bank of Japan confronts significant limitations on implementing direct interest rate hikes due to debt sustainability concerns. Therefore, in place of abrupt rate increases, analysts foresee a measured escalation in interest rates. This is expected to unfold through careful modifications to the yield curve control program, alongside calibrated adjustments in asset purchases and refinements in special lending facilities, gently steering towards tighter monetary conditions. A key concern for the Bank of Japan is avoiding a return to prolonged deflation. Governor Kazuo Ueda has emphasized the need to prevent this scenario, indicating that sustained wage growth above 2% is essential. In March, Japan's major corporations engaged in Shunto, or the Spring Wage Offensive, negotiating wage increases for the upcoming fiscal year. This negotiation impacts wages across the board and could set the stage for a monetary policy shift in Japan. The outcome of the 2024 Shunto will be a critical indicator of Japan's monetary direction. Turning to the currency markets, particularly the US dollar-Japanese yen pair, much of the correction might have already occurred with the recent recalibration in the US rate outlook. Maintaining positions in yen pairs like US dollar-Japanese yen pair has been advantageous due to favorable carry benefits. Yet, for investors betting on the yen's rise, the substantial negative carry presents challenges. This scenario is likely to continue until the Bank of Japan moves away from negative interest rates in the coming year. It's also vital to consider an alternative scenario where the yen may not exhibit the expected strength. The risk arises if the dollar strengthens, possibly due to the Federal Reserve not significantly cutting interest rates amidst a strong economy. In turn, bond yields may not drop as anticipated, enhancing the appeal of fixed income investments and diminishing the potential gains of low-yield assets like gold and the yen. As we look forward to 2024, it's clear that the global economic landscape is marked by a mix of challenges and opportunities. Geopolitical fracturing remains an ongoing source of risk, with potential cross-asset implications. From the US labor market dynamics to the shifting policies in Europe and Japan, traders will need to navigate carefully through this complex terrain. Thank you for joining us on this special segment of Market Radar. Don't forget to follow Derek Vlog for more sharp market updates, comprehending policy impacts and in-depth analysis for the year ahead.